The property market's going to crash. Well, how many times have you heard that one recently? Of course, last year, 2021, was a year like no other. Prices boomed, creating new records, and as the value of Australia's housing markets skyrocketed, the collective wealth of homeowners around Australia jumped by over $2 trillion, despite the pandemic. And sure, it's clear we won't have the same level of overall price growth this year, but a housing market crash? I don't think so. And that's despite all the messages in the media suggesting it will occur. Now, if you're a regular listener to this podcast or you follow my blogs, you know that I have a weekly video chat with Dr. Andrew Wilson, Australia's leading housing market economist. Well, today's podcast is an audio of one of my recent chats with Andrew, who's got an enviable record of property market forecasts. And together, we're going to share with you 10 reasons why we don't think we're heading for a property market downturn, not in the near future. So, welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
2022 has already turned out to be a fascinating year in real estate. Last year was unusual, where we experienced a once-in-a-generation property boom and values grew strongly almost everywhere. But now there seem to be more pessimistic forecasts about the short-term future of our housing markets than there are positive property market commentators. But if you've been watching our regular Property Insider chats, you'd know that we believe property values will still grow this year, but more slowly, and the markets are going to be more fragmented. But of course that's normal. But since the property pessimists are getting more than their fair share of headlines, today I want to chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, about 10 reasons why we're confident about our housing markets moving forward. Hi, Andrew.
Hello, Michael. And it is remarkable the consistency that we generate these fear campaigns over the prospect of housing market activity. And yet history tells us quite clearly that there is nothing to fear but fear itself. And I think we'll prove that truism will prove to be correct again for this year.
Now, Andrew, I don't want to minimise the horrors of war and the obvious humanitarian disaster that's occurring in front of our eyes, nor do I want to downplay the terrible effects of the floods in Australia or the effects supply shortages and rising global food prices are going to create in the developing world. However, today I'd like to concentrate on some of the good news that can easily get lost and why I am still, in fact I know we are both, confident about the future of our housing markets in Australia. And let's start with the fact that currently the average Australian is wealthier than they ever have been.
Well, of course, higher property values have worked into that. We always look at the proportion of debt that's increased, Michael, with house prices rising, because, of course, people have to borrow more in an aggregate sense to buy a house when prices are booming. And that's, of course, occurred, as you said, that once in a generation increase in prices last year has meant that there's been significantly higher levels of borrowings. But that's not really the story. It's firstly about the proportion of your repayments in terms of your average of your income. So if that's relatively stable, well, why wouldn't you borrow more if you're repaying proportionately the same level of your income? But the other end of the equation isn't debt, it's actually equity, as you mentioned. And if your assets are climbing strongly, it means your balance sheet is certainly in positive territory. And that's what we've seen. The wealth created by higher house prices has had a positive impact on household balance sheets. And that's the offset for debt. You just don't look at one side of the story. You've got to look at the full picture, which is debt versus assets versus the capacity to service your debt. And we're in a better position than we've ever been in terms of those measures.
Sure. Well, it's suggested that there's a huge war chest of maybe even up to $230 billion in household savings. As you said, most homeowners have got significant equity. If they bought more than 2 years ago, many have got more than 30% equity in their home. Their share portfolio is doing well. Their superannuation fund's doing well. And good point about the debt, Andrew, because while the overall property market's valued at close to $10 trillion, there's only about $2 trillion worth of debt. I'm saying only 2 trillion, but if you look at it, it's actually only a 20% loan to value ratio over the whole residential market. That's not a risky position at all, which makes me come to the next point that makes me feel confident, Andrew. There's no sign of mortgage stress for the majority of borrowers at present.
Yeah, what happened to the debt bomb, Michael?
I forgot about that.
Yeah, well, most people have, but that was a great story for a few years, wasn't it? The great debt bomb. I'm sure it'll be wheeled out again, and it was the cheapest of cheap headlines from those clickbait seekers. But yes, we do have very low levels as usual of mortgage defaults and also arrears. And of course, the important thing about mortgage defaults and arrears, Michael, is that they would typically follow the level or the labour market in terms of highs and lows. Of course, we now have the lowest unemployment rate since, just about on record for the series, but certainly the lowest since 2008. And of course, we know that we will start to see incomes rising, albeit perhaps gradually because of the nature of our wage setting system in Australia. But incomes are certainly on the rise, which means any issues with arrears and defaults are offset by increased incomes and the capacity to find work, because arrears and defaults usually increase as unemployment rises. And we're certainly going strongly in the opposite direction there. So yes, the debt bomb has become, I guess, a bomb of egg all over the faces of those that promoted it. But they got some headlines, so good luck.
Boy, didn't they? Well, it's suggested that many Australians are well ahead of their mortgage repayments. I was interested to read on the weekend that the ANZ Bank believed 70% of all its mortgage holders are well ahead in their mortgage payments, and it's estimated that there's $1.37 billion sitting in offset accounts or redraw accounts. And we also know that half of homeowners don't even have a mortgage. So
Yes.
there's no evidence of mortgage stress. And currently interest rates are low. And even if they do rise, and we know they will eventually, Andrew, I believe it would take 0.25% interest rate rises to bring them back to where they were 3 years ago. And there was minimal mortgage stress back then.
Well, we've discussed the prospect of higher rates in the outlook, Michael, and they still are dependent on higher wages.
Yep.
We're certainly a long way away from a consistent 3% plus annual increase in wages, which the Reserve Bank has used as its benchmark. I still think that's not going to occur, if it does occur, until next year, getting that consistency. We also have, as you said, the buffer on interest repayments. Mortgagees have a 3% buffer to cover the risk of higher interest rates. I'm not sure we're going to see an extra 3% anytime soon in interest rates, but the prospects for higher rates are still remote. But the offset to that is, firstly, higher rates would only come off the back of higher incomes. The Reserve Bank has told us that. So that would give, obviously, some capacity to absorb higher rates, which will only be incremental to start with, perhaps 0.25%. And the Reserve Bank would tread very carefully going forward. And the other point to that, you mentioned high savings levels, Michael. Saving levels are at near record levels at the moment, around about 15% savings ratio, which is below the record, but still very, very strong. So that gives households some capacity to absorb extra mortgage costs above their increased incomes. Well, I think that it's interesting, Michael, also when we speak about the debt of Australians in terms of the broader property market, we need to understand that around 40% of houses are tenanted, so they're not owner-occupiers. And of that 60% that remains, half of those actually own their own properties outright. So interest rates aren't a factor for them. And half of that 60% actually have very, very low levels of debt in their properties. And it's only the other half that have higher levels of debt and are therefore exposed to higher interest rates or higher unemployment. And as we've suggested, both those factors certainly are negligible in the outlook in terms of creating any sense of mortgage stress. So we are only talking about a snapshot of Australian households that would be exposed to perhaps mortgage stress as a result of higher interest rates or higher unemployment. And it's not a sort of thing that's going to affect the whole of Australia's housing market. It's only that small snapshot that are affected.
Sure. Well, the investors, even though they're going to be affected, are going to be able to write it off as part of their negative gearing or tax benefits. So it's not going to cost them as much. And it really is going to be more the first home buyers who had to get into the market with high leverage. But in general, they'd rather eat Maggi noodles than sell up their home. So they're not going to end up selling up and making the property market crash, Andrew.
And they have the bank of mum and dad to rely on, and they have a queue of employers looking for workers at the moment. So seriously, it's not that hard to find a job at the moment, Michael, even if you're a first home buyer. And of course, we know also that the government promoting fiscal stimulus packages to offset high inflation. So that's another handout that households can use to offset higher interest rates if they come. Above all that, of course, we're certainly seeing the prospect of continued low unemployment and jobs growth, providing income for basically the workforce as a whole.
Well, that's another factor. Really, employment is strong, and that's because our economy is growing, and it will continue to do so. And anyone who wants a job can get a job. Unfortunately, the issues overseas are creating havoc there, but it's going to increase our export income. And moving forward, our tourist income is going to improve as well, now that our international borders are opening. So Australia's economic position, and I guess our employment position, is looking good moving forward.
Yes, Michael. And I think the big picture is we will be resuming mass migration. That's a commitment both sides of politics or all political parties. Australia is a high migration country, and it's not just an economic proposal. It's also a cultural proposal that we embrace. And that means increased demand for housing, particularly. We already have a shortage of housing in this country. We only have to look at how rents are going through the roof at the moment to see that there's an emerging rental crisis in a number of cities, with tenants and prospective tenants being unable to secure shelter. And with a flood of migrants coming in, that will only exacerbate that problem. And of course, extra migrants will also help to moderate a shortage of labour as well. And this is all good news for our economy. And the other point is open borders will encourage tourism and business travel, and states such as Queensland, which have suffered through closed borders, will certainly resonate with the resumption of strong tourism, hopefully in prospect with open borders as well.
We've said it in previous chats, but it'd be wrong not to mention it again, that if you just look back at history, while lowering interest rates helped boost our property markets, rising rates didn't cause markets to fall in the past.
There's the history, as you said, Michael, shows us that even with a concerted increase in rates, or over a concerted period, higher rates have only tended to have a lagging effect on house prices. It's taken some time for it to impact affordability. And that's because obviously higher incomes are part of what drives, and higher inflation are part what drives the RBA to act with higher rates. So it means that you can absorb those higher rates. And it only is at that point where affordability starts to fall because incomes aren't catching up with those higher rates, where you do see lower prices. But prices growth tends to just flatten rather than fall during a period of higher rates. And that has to be a consistent period, Michael.
And as we've already hinted, rents are going to be rising this year. There's a shortage of rental properties, which means it's more likely investors are going to be back in the market. And that's what we're seeing with finance figures as well. So investors will help underpin the market. And I think just the general wealth of the nation is going to continue the trend of upgraders. That's what drove the property markets last year. People just looking to upgrade their lifestyles in this new COVID normal environment.
And there's lots of interesting factors when we do look at buyer types, Michael. Firstly, as you mentioned, investors are surging back into property markets, keen to take advantage of capital growth, as well as those consistently relatively high yields that they're getting. With a shortage of rental stock, that will continue to put upward pressure on rents, and that will keep those yields reasonably stable. Of course, there is all those tax advantages that investors have. We still have investment activity below long-term averages, so there's plenty of upside for investor activity. And I would suggest that APRA this time, thankfully, won't be interfering with that rise in investor activity, which has certainly caused some significant issues, particularly on the supply side of housing markets, from those actions back in 2015 and 18. But the other point I think is interesting are first home buyers, Michael. First home buyer numbers have certainly eased over the last 6 months. No surprise, because first home buyers are the most exposed to higher prices because they don't have a trade-in to bring into the market. So they can't take advantage of a higher price for their trade-in. They have to rely on savings for their deposit. And of course, if prices are rising faster than savings, that's bad news for first home buyers. we don't have all the incentives we had a year ago for first home buyers as well. But first home buyer numbers, Michael, have actually perhaps surprisingly stood up over the last few months. And what I think we're seeing is the bank of mum and dad quite active in first home buyer activity, which hasn't fallen away as sharply as I thought it would with higher prices. And I think that's part of that intergenerational wealth shifting that's going on. Baby boomers, bringing forward their inheritance to their children and grandchildren in terms of keeping them in the housing market. And it's just that Australian regard for property as, I guess, a gold standard as an asset class. And I think that's quite interesting for first home buyers. So I think we'll still see first home buyers very keen. They're always keen, but not. It's one thing just to be keen, Michael, but you have to have the pounds, shillings and pence, the dollars and cents to get into the market. And I think they're getting a leg up at the moment from their parents and grandparents just because of that regard of security in housing investment.
Well, one of the things the property pessimists are talking about at the moment, Andrew, is, hey, look at the statistics there showing that the Melbourne and Sydney property markets have been flat. And while overall they have, in my mind, it's a bit like putting one hand in a bucket of hot water and another hand in a bucket of cold water and saying, on average, I'm okay. But the markets are still in certain segments doing very well, aren't they?
Well, affordability has certainly constrained the Melbourne and Sydney markets. You just can't keep bidding up prices, going to the bank and asking for more and more money when there aren't either lower interest rates or higher incomes, which we haven't got. So those markets have run out of the capacity to push prices up, but sales volumes are still similar to where they were a year ago. And that shows that it's not just all about prices growth, Michael, it's also about turnover in the market. And turnover is still strong. Buyer and seller appetite is still at the boom time levels this year or similar to last year. But of course, the capacity because of affordability constraints isn't there to push prices up. However, of course, Brisbane and Adelaide are clearly more affordable markets than Melbourne and Sydney. So they have some way to go before they reach that threshold where affordability starts to bite in their capacity to push up prices. And other factors as well. We have a surge in migration, of course, continuing into Brisbane, which is helping to create increased demand compared to the other capitals. But, you know, with mass migration, international migration about to resume, that will stimulate demand, particularly in the Melbourne market, which is always a target for migrants. But again, it's all about the capacity to borrow more, Michael. So even if you've got a line of people looking to purchase a property and there's strong bidding, it's up to the bank whether or not you can borrow. And that means your incomes have to be rising, borrow more, or an interest rate would be falling to give you that capacity. So that's a good thing. It moderates the capacity of price growth, therefore moderating the outlook for house prices.
On balance, there are definitely headwinds ahead. We've got an election, which is almost certainly going to slow down market activity. It always has. There are overseas problems. There's always going to be the negative media. But on balance, there's more good news than there is bad news, isn't there?
Yes, well, we're coming up into April now, Michael, can you believe? And of course, April is the holiday month. So we have distractions anyway through April because of Easter, Anzac Day, etc. Easter is later this year, of course, which has had some implications for our auction markets. But also, I think that once the budget's out of the way and done and dusted, we'll also likely be commencing a lengthy election campaign, and that might occur through April. So that will exacerbate April as that holiday distraction month. We'll have the major distraction of an election campaign. So that will obviously impact certainty in a sense in parts of the housing market. But once these things are put to bed and we have a new government and the holiday season's behind us, the positives are all there, as you've so explicitly explained today, Michael.
Well, following on from my chat with Andrew, I'd like to just remind you that we're currently in a two-speed property market. House price growth in Sydney and Melbourne has continued to decline over the first quarter of this year, while at the same time other capital cities are recording boom time housing market conditions. Now, Melbourne and Sydney had minimal growth in the first quarter of this year. Of course, if you annualise it out, they've still had very strong growth over the last 12 months. That sort of takes into account the high growth last year. But there isn't one Melbourne property market, there isn't one Sydney property market, so within those markets there are certain segments that are still undersupplied for good properties in proportion to the number of people who are still wanting them, and that's pushing up property values in some areas, while in other areas property values are going to languish and fall by the wayside a bit too. Of course, the Brisbane market's doing really well. It grew 33.8% over the last 12 months, according to Dr. Wilson's My Housing Market. It grew 5.4% in the last quarter. Now, that's not growing as fast as it did last year in 2021, but you can't. But even if you work out 5.4% over the first quarter of this year, boy, is that strong growth if you annualize it out. Now, as we said at the end of our chat, there are going to be some hurdles as the year goes on. All that means is that there are still opportunities, but you've got to be much, much more careful, much more selective, and you can't just buy any property. Last year, everyone looked smart, and almost wherever you bought, property values increased. But if you want to even the odds, actually, if you want to stack the odds in your favour, I believe you're going to need to get a good team around you. And that's why I'm going to unashamedly suggest you have a chat with my team at Metropole. We don't sell property, and we always start by putting a plan together to help you understand what's possible, what's realistic, what's viable, what you can achieve, taking into account what else you want to do with your life. And then we help you implement the plan using our buyer's agent services. We have property management, renovations, development, business advisory, wealth advisory, financial planning. You may choose to use some of those services or all. I don't know what your requirements are. So we don't have a cookie-cutter approach, but we have our own teams on the ground in Melbourne, Sydney and Brisbane to give you the right perspective as well. So with the markets moving but changing in front of our eyes, go to metropole.com.au, find out about what we do, and why not have a chat with one of our property strategists. And even if you're not ready to do anything just yet, why not get all your ducks in a row to be ready when things become a bit clearer moving forward. Of course, we help beginning investors and experienced investors. Metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset moment, I want to point out to you that to be successful, you're going to have to do the opposite of what almost everybody else is doing. To find success, sometimes you're going to have to dismiss common beliefs. You're going to have to do the opposite of what most people are doing. Let's be honest, most people don't get the success they deserve. I guess what I'm trying to say this time, though, is there are so many sayings we just take for granted as true. You better look at them. You better look at them more closely because they make absolutely no sense. For example, statements like, you can't have your cake and eat it too. Well, what's the point of having a cake if you can't eat it? You probably expected me to say that one, didn't you? Or what about this one? Don't look a gift horse in the mouth. Well, if you think about it, isn't that exactly what the Trojans should have done? The point I'm trying to make here, maybe not so well, is that if you want to be a successful property investor or business person or entrepreneur, you're going to have to think differently to most other people. You're going to have to think differently to how they think. You're going to have to do things differently to what most people do. As I've written in my book, Rich Habits, Poor Habits, you're going to need to adopt rich habits, the habits of successful people, and you're going to have to give up poor habits, those that are shown by most unsuccessful people. And it will require deep programming of many of the common beliefs and assumptions that you've come to take as granted, that you've come to take as true. Anyway, today I'd like to share two of these beliefs with you, suggesting that you let them go. And the first one is put all your eggs in one basket. Common wisdom seems to suggest you should diversify your investments. But is that really correct? In my opinion, it's not. In fact, I remember reading Napoleon Hill's great book, Think and Grow Rich, many, many years ago, when he said that successful people specialise. They find one area that they're really good at, and they don't diversify. On the other hand, you'll find many financial planners tell you diversify. Why? Because if you put all your eggs in one basket and something happens, like dropping it, you're going to lose everything. But I've got a solution for that. Take good care of your basket. Warren Buffett said it well. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Robert Kiyosaki put it a different way. Many financial advisors recommend that you diversify for your own protection. What they fail to tell you is it's also for their protection, since most financial advisors can't tell you exactly what stock or managed funds is a great investment. They tell you to buy a bunch of them. They tell you to diversify. But as I said, in my mind, diversification leads to averageness. Bottom of the best and cream of the bottom. I found that wealthy people, successful people, be they a business person, entrepreneur, or investor, they've got one thing in common. They specialise. They all focus their concentration on one single earning activity. They eventually become exceptional at that one activity by continuously improving their skills, increasing their knowledge in that one activity. Despite the myth that's going around that it's good to have multiple streams of income, the wealthy very rarely engage in multiple earning activities. I remember one astute colleague of mine saying, if I try and do 5 things to earn money, I lose money in all 5 things, so I focus on doing one thing really well. So if you want to get rich, you've got to be great at something. And to be great at something, you've got to focus at doing that something. And that's where you put all of your eggs. Now, sure, in due course, you should diversify. Within property, you should diversify to different states or different types of property. I'm not saying that. I'm suggesting that businesses should have multiple streams of income eventually, but you've got to get to that point. Don't start off that way. So put all your eggs in one basket and look after it very, very carefully. The other myth I want to dispel in today's mindset session is always be on the lookout for new opportunities. Now, if you're like me, you're getting potential opportunities in your inbox every day. Opportunities like alternative investments, the next hotspot, the secret to success, the secret to untold wealth. I remember recently a client saying to me, Michael, I'm constantly coming across great opportunities. How do I choose which one to follow? In my mind, opportunities can be like obstacles if they take your focus away from what's in front of you right now. I've made more by saying no to perceived opportunities than by saying yes to them. I know it's exciting to chase the next shiny toy, but to become a successful property investor or successful at anything in business in your profession, you've got to do the same thing over and over again. You only become an expert by doing one thing 100 times rather than 100 things once. How do you know when you're an expert? When you can consistently get the same result in any market. On the other hand, you lose time and focus when you entertain new ideas, research them, find out a bit more about them. Next thing you know, you're scattering all your focus, scattering your energy. So choose one area you want to specialise in. Maybe it's property investment, maybe it's renovations, maybe it's your profession, maybe it's your business. Remember, there are always going to be lots of opportunities in any field. Make sure you're doing well with one thing. Become an expert at it. Get rich first, and then you've got the luxury of pursuing other opportunities. So the bottom line is, if you want to become rich, if you want to become successful, do the opposite of what most people do. Well, I hope after listening to Andrew and me today, you've got some more clarity about what's ahead and you're not going to lose sleep over what's likely to happen in the property markets. Of course, there are always unknowns, but that's why I'd like you to come back regularly to listen to this podcast and learn from the experts that I chat with regularly. Now, if you did get some benefit, though, and you know somebody else who will, please do me a favour and tell them about the Michael Yardney podcast. In fact, do them a favour, but help me in my quest to make as many Australians financially fluent as possible. Of course, you can catch me in between these shows on social media. Just look for Michael Yardney, or why not join my private Facebook group? Go to Facebook and look for the Property Update private Facebook group. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?